All right, let's dive right into this explainer and demystify exactly how to get financially free, escaping that daily grind once and for all. We hear the term financial freedom thrown around a lot these days, right? Usually it's paired with flashy images of private jets or somebody retiring on a beach at 30, probably holding a very expensive cocktail. But if we actually look at the data and the most effective financial frameworks out there, the real path to getting financially free is a lot more systematic and, frankly, way more achievable than social media leads us to believe.
So first things first, we've got to totally redefine what financial freedom actually is. It is not about a sudden lottery win, a random inheritance, or picking that one lucky crypto coin. As this quote perfectly sums up, it's a ladder. It's a methodical, step-by-step climb. You don't have to figure out your entire financial life in one giant dramatic leap. You really just need to know exactly which rung of the ladder you're standing on right now and what it takes to step up to the next one.
So here is your blueprint to freedom. Today we're going to cover 1. The freedom ladder. 2. Escaping the debt trap. 3. Finding your FIRE number. 4. The automated wealth engine. And finally, 5. Avoiding the hidden traps. Okay, let's start with part 1, the freedom ladder.
Now, this ladder is super helpful as a psychological anchor, letting you know exactly where you stand without getting totally overwhelmed by the big picture. We start literally in the basement with step 1, dependence. This is where you're relying on borrowing or relying on others just to cover your basic spending. The primary goal here? Just stop slipping further down. That takes you up to step 2, solvency. Here, you can finally cover your essentials from your own income, even if there's literally nothing left over at the end of the month. Eventually, by tracking things and living slightly below your means, you battle your way up to step 3, stability. That means having a 1 to 3 month buffer so a minor flat tire or unexpected bill doesn't cause a total panic. And then comes a massive milestone, step 4, security. With a 3 to 6 month buffer and the right insurance, money finally stops dominating your everyday thoughts. Seriously, the stress just melts away.
Then, as you climb up to those final 3 levels, your life shifts dramatically from simply surviving to experiencing real, actual choices. Step 5 is flexibility. Now, this isn't just about a high bank balance. It's the ability to hit pause. It's knowing you could survive a job change or take 6 months off to upskill and it wouldn't be a crisis. Then we hit step 6, which is true financial independence. This is where your invested assets completely support your lifestyle. Employment? Totally optional at this point. Finally, step 7 is abundance and legacy. This is where you actually have more than you need, and your focus shifts to long-term stewardship, like how your wealth can support causes you care about or protect your family way beyond your own lifetime.
All right, moving on to part 2, escaping the debt trap.
So before you can even think about reaching those upper levels of flexibility and abundance, you have to tackle the absolute hardest foundational rung, escaping high-interest debt. You simply cannot compound your wealth if your credit card debt is compounding against you at like 24%, right? Now, when you're tackling this, there's actually a really fascinating clash between traditional math and behavioral psychology. The debt avalanche method tells you to pay off your highest interest rate debts first. Mathematically, sure, this is absolutely the fastest and cheapest way to get out of debt. But on the flip side, we've got the debt snowball method, where you pay off your smallest balances first, completely ignoring the interest rate. Why on earth would you do that? Well, human psychology. Wiping out a small debt gives you this immediate, huge mental victory. It builds motivation. The data actually shows that while the avalanche is technically more efficient, the snowball method is a fiercely close competitor purely because it stops people from giving up halfway through. So just choose the one that's going to keep you moving forward.
That brings us to part 3, finding your FIRE number.
Okay, once your bad debt is gone and your security buffer is in place, it's time to calculate your exact mathematical target for financial independence and retire early, what we call FIRE. The absolutely crucial point here is this classic multiplier, 25. This comes straight from the famous Trinity study, which essentially found that if you have a diversified portfolio, you can safely withdraw 4% of it every single year in retirement. And because math is awesome, dividing by 4% is exactly the same as multiplying by 25. So you just estimate your annual living expenses for retirement and multiply that number by 25. That's your FIRE number. So if you need $60,000 a year to live, your target is $1.5 million. Bam. It gives you a crystal clear, unambiguous target.
But hold on a second. We've really got to ask a vital question here. Is that number actually safe? You see, the 4% rule was based on historical market data primarily from the US, and it assumed a baseline inflation rate of around 2 to 3%. But does that standard actually hold up in every single economy around the world?
Well, the short answer is no, not really. You absolutely have to adjust for your local reality. Let's take high inflation economies like India, for example. There, the standard 4% rule is just way too risky. When you factor in a general inflation rate of 6 to 7%, and then skyrocketing healthcare inflation, which sits around 12 to 15%, a fixed corpus is going to deplete so much faster than the original Trinity study ever assumed. So, in these types of environments, financial planners strongly recommend using a much safer 3 to 3.5% withdrawal rate. Mathematically, what that does is push your target multiplier up from 25 to somewhere between 28 and 33 times your annual expenses. So the big takeaway? Definitely know your baseline, but make sure you build a specific margin of safety based on the economy you actually live in.
All right, Section 4, the automated wealth engine. So now that you know your exact target number and you factored in your margin of safety, you need the actual engine to get you there. And that engine is automated index fund investing. People so often get totally paralyzed trying to pick the absolute perfect stock, but just look at these two massive funds from Vanguard. VOO tracks the S&P 500, so the 500 largest U.S. companies. VTI tracks the entire U.S. stock market, which is over 3,500 companies. Notice anything? They both have a rock-bottom fee of 0.03%. I mean, that's practically nothing, and their 10-year returns are almost identical, right around 14 to 15% annually. They basically move in near-perfect lockstep. This totally demystifies what you should buy. Just pick a broad, low-cost index fund, and boom, you immediately own a piece of the entire economy's growth.
But honestly, picking the fund is maybe 10% of the battle. The true secret to making this engine work is entirely behavioral. It's about setting up a fixed, automatic monthly transfer straight from your checking account into your investments. You buy consistently whether the news anchors are saying the market is hitting all-time highs or all-time lows. And the absolute most important rule of all, when the market drops and everybody says the sky is falling, you do absolutely nothing. Seriously, do not sell. You just sit back and let your automated system buy those shares at a massive discount. By totally removing your own human emotion and the temptation to time the market from the equation, you practically guarantee your long-term success.
Finally, Section 5, avoiding the hidden traps.
As you start building real wealth, you're going to encounter some incredibly insidious traps, and the most common one, by far, is lifestyle inflation. It is this quiet, sneaky creep where a pay bump magically turns your $5 coffee habit into a $15 artisanal pour-over habit. You feel richer, sure, but your actual savings rate hasn't moved an inch. Lifestyle inflation is so dangerous because it secretly burns up your newly created wealth before it ever has a chance to actually compound in your investment accounts.
So how do we fight back against our own natural desire to just upgrade our lives? Well, you deploy this simple, brilliant little behavioral trick called the half-raise habit. It works like this. Every single time you get a raise, a bonus, or some unexpected windfall, you immediately commit to saving or investing exactly half of it. The other half, you use that to improve your lifestyle today, completely guilt-free. It's the perfect balance, really. This ensures your future freedom grows every single time your present income grows.
But hey, it's not just behavioral traps you've got to watch out for. There are mathematical ones too, specifically something called sequence of returns risk. Imagine this. You finally hit your FIRE number. You march in and quit your job, and then literally the very next month, the stock market crashes by 30%. Because you're now withdrawing money to pay for your life, you are forced to sell your assets at rock-bottom prices, and that permanently damages your portfolio's ability to ever recover. So you have to protect yourself from this. How? By keeping a cash buffer, usually 2 to 3 years of living expenses, completely outside the stock market during those crucial early retirement years. That way, if the market tanks, you just live off the cash and give your investments the time they need to bounce back.
Because look, at the end of the day, getting financially free isn't really about just escaping work. It's about claiming the freedom to choose exactly how you spend your time on this planet. So as you go out and build your own personalized plan for work optionality, ask yourself this one final, really important question. If your money truly aligned with your deepest values, what would you stop doing today? Finding the answer to that question is going to uncover the true purpose behind the wealth you're building. But remember, this is just the beginning of your climb. There is so much more to mastering your money out there, so keep digging, keep learning, and start stepping up that